Welcome to another episode of IJS Speaks. This is your neighborhood financial economist, KD Mark. Today's episode is titled Chart Patterns Paint a Clearer Picture. So there's this cup and handle formation that's evolving on a 3-month chart of the dollar index, and I think the chart is presenting at the beginning of the handle portion of the chart pattern. I've been watching and trend trading the dollar index against a basket of currencies because I believe that the forex markets are the most immediate link to the macroeconomy, as far as financial markets go, anyway. And we are certainly living in interesting macroeconomic times. Cup and handle patterns, they tend to signal a continuation of a trend in the direction of the breakout. So when I saw that, or when I first saw the pattern that I thought was a cup and handle, I immediately zoomed out to a 1-year chart, and that's when I saw what I thought was a kind of weird double bottom formation, because again, I look at the dollar index all the time on different time frames. So what I thought was a weird looking double bottom formation, if I factored in a possible cup and handle, all of a sudden had the potential to be a not so weird inverted head and shoulders. So technical analysis talk aside, all three of those chart patterns were telling me the same thing. That is, the dollar was queuing up for a move higher. So the cup and handle overlays the best with the current narrative in financial markets. The dollar first started trending higher as the debt ceiling negotiations began intensifying, and the date estimated by the Treasury when America would run out of cash to pay its bills approached without an agreement. Before that point, the dollar was trending sideways for about a month. And before that, it was trending lower for about a month. So the short-term peak in the dollar, that occurred around the time that the agreement was reached between Democrats and Republicans about the US debt. That's when the pattern caught my attention, as the price on the index started rolling over into what I think is the beginning of the handle. The next macro event on the economic calendar is the June Fed meeting, so the 13th and 14th, sometime next week. Actually, not sometime, Tuesday and Wednesday of next week. And that meeting will conclude with the Fed either deciding to raise interest rates or to hold them at current levels until their next meeting in July. Now, the market consensus appears to be that the Fed will hold rates steady at its next meeting and maybe even at the subsequent one, which is in line with what Fed officials have been saying. But after that, the two go their separate ways. The Fed has and continues to say that rates are meant to stay higher for longer, and market participants are continuing to suggest that rate cuts can begin as early as the fourth quarter of this year. Financial markets are also implying that because the Fed should be cutting rates by year's end, the dollar has peaked and should be weakening as higher foreign rates begin to look more attractive. The old carry trade. In my mind, the inevitable divergence of views between the Fed and market participants completes the handle of the formation. The capitulation of market participants will later drive the breakout of the pattern, which in the longer term time frame would line up with the breakout of the inverted head and shoulders. Let me explain. Markets agree with the Fed that rates remain unchanged at the June meeting, which to the Fed means rates remain unchanged at the June meeting, nothing more. To market participants, however, it also means rates have peaked, and after a short pause, they're coming down, and so the dollar sells off. When we get to the next meeting, if there is still no rate change because monetary policy operates with a long and variable lag, as everyone has been saying, markets will infer that we're even closer to a rate cut, especially if the economic data worsens, so the dollar may tend to trade sideways in a holding pattern. Finally, the capitulation. This can or may occur when later in the year the Fed surprises markets with a rate increase despite further deterioration in the economic environment, simply because inflation will have remained sticky above their 2% target. Short dollar positions will have to cover losses. Some of them will even reverse course, all of which will push the dollar higher. Then there's the issue of the Fed further tightening monetary policy while economic activity slows, while labor hoarding and consumer credit keeps a floor under inflation. Economic weakness at home and abroad could move the needle on market sentiment towards one that embraces the potential or even the necessity of a recession to satisfy the Fed and other central banks with their coordinated fight against inflation. Historically, however, in environments where global sentiment sours, investors tend to flock to the dollar and U.S. government debt for safety and liquidity. So, what some market watchers and participants would call a monetary policy mistake, if or maybe when recessions are created to fight inflation by central banks, this may indeed be the unspoken objective. This has been another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. When in doubt, take profits.